My name's Eddie Donmez, lead content creator at Finimize, and I'm here today with a very special guest, Beth Kindig, who is the lead tech analyst for the IO Fund, and she'll be running an extremely timely workshop today, Tech Stocks to Watch in 2023. Before we get into the session, some housekeeping. If you haven't already, obviously, please introduce yourself in the chat box with your name, where you're tuning in from, and there should be a poll popping up just about now. So if you could answer that, that would also be great. This is going to be a 30-minute discussion workshop style thing, followed by 15 minutes of audience Q&A. So don't forget to ask your questions in the Q&A box throughout the session, and then we'll get to them at the end, because I'm sure you'll have a ton of questions for Beth. So Beth, let's take it away.
Thank you so much. I really appreciate you asking me to be here. I'm happy to be back again this year. So I have a presentation for everyone, which is on the tech stocks to watch in 2023. Very timely discussion, as obviously tech stocks are trading at a steep discount. Much better to buy at the bottom than at the top, that's for sure. So, but I also think we need to be really pragmatic about it. 2022 is really tough on many levels, macro related. And right now it's looking like 2023 will resemble 2022 more than it has, those bull market years prior. So the goal for today is to first really just touch base and make sure that we address probably what is the biggest mistake that investors make, especially with tech stocks. So I want to make sure that, I preface the rest of the discussion around what kind of investor are you, and are you really a tech investor? And then we'll go through very quickly what 2022 had in store for us this year. We still have a couple weeks left, but certainly hasn't gotten any easier the more the year has gone on. But we want to draw some conclusions from this year and create parameters for 2023. From there, we'll go through some case studies, including some specific tech stocks that fit those parameters. Two of them that we are invested in at a larger allocation. And I'll show you exactly why, rather than giving you a lot of fluff or emotional appeal around the stock. I want to show you exactly why I think they might be fitting the parameters of 2022. And then a few more things to watch for in 2023. These are more cautionary tales that I've seen from my experience. For those of you that don't know me, I write weekly for free on a newsletter, and then I am on a daily basis on a premium site. But I did get started in tech, analyzing tech in the private markets and startups about 12 years ago. So I've seen a really boom and bust cycle in the private sector, which actually I would say was booming 2010 to about 2015, and it started to bust after that. It may not feel the same cycle that we're feeling today in the public markets, because everything that happens in the private markets happens first before it reaches the public markets. So I'll touch base with some cautionary tales that I've learned from the boom bust cycle of the private markets over the past decade. So I think the single biggest mistake an investor can make, and I do want to touch base on this because there's no year variable that can change this mistake if it's being made, or it can change your returns. This is what kind of investor are you? And I brought up the European ski slope ratings since most of you are in Europe this afternoon. It's morning for me. But ultimately, if you're a beginner skier, you would never think to go on a black diamond or a double diamond, or you'd get really hurt. Investing is no different. And the way that I would say who's a beginner, who's an intermediate, and who's an advanced is not only time in the market and how many years of experience they have, but how much time can you actually dedicate to this? People who work a 9 to 5 and have absolutely no time for the markets, are just scrolling on social media, aren't able to perform their own due diligence. I would highly recommend, I'm not a financial advisor, but that they stick with mega cap companies. There's great opportunities in tech at the mega cap level, but they don't need a lot of risk management, quite like mid cap and small cap. These are very high risk assets. So ultimately, if you're a beginner, and again, this isn't about how savvy you are or how intelligent you are. It has to do with how much time you have. The market requires a lot of time. And if you're buying a stock and you're not able to perform risk management, you're going to get hurt. So beginners should stick with mega caps. And I have a couple in this presentation to talk about. Intermediate, if you're actually looking at the markets on a more regular basis, maybe you're in your evenings or your weekends, you could probably move up to a mid cap. But again, with risk management, and I'm going to go through some risk management tools at the end of this presentation for each level. Beginners have very little risk management other than to hold for a long period of time. Intermediate, you might put a stop on your positions to where if you're not at your computer and something happens, like a short report, for instance, we saw something go on with dLocal, you can stop out very quickly. Advanced, they look at the markets daily. So small caps are okay for people that look at the market daily. And if you're not looking at the market daily, the failure rate of small caps is much too high to be getting involved in. So I do want to differentiate all of that. I think SPACs and small caps got a lot of people hurt because they were beginners skiing on an advanced slope. When they started to turn south, there was no real risk management other than to hold on and pray. Not the best risk management for a small cap. That's a totally okay risk management approach if you want to hold on for your FANG level stocks. So I think that's really important to preface all of this with, because nothing can really change that piece. So the other thing, just really quickly, are you really a tech investor? So right now I can tell you, I truly identify as a tech investor. Value stocks don't look good to me, even this year or ever. The reason is that I believe over a 5-year period, I will outperform every value investor because of the fact that I'm very comfortable with high risk, high reward. Does this roller coaster that is pictured, does that freak you out? Because the highs are high and the lows are low. There's really no way to get those high highs if you don't have the low lows. So it's very much like a roller coaster, and you've got to be comfortable with the market attempting to flush your hand. So how, and one other point is, how long do you plan to hold for? The longer you hold, the better your returns. All of my 2018 and 2019 entries are doing very well right now. All of them that I've continued to hold, I should say. If I stopped out, something like that, I'm not counting those. I'm saying those that I decided to hold for the long term, they're all doing very well right now, even with the 70% drawdown. But with that said, you also have to be flexible. So it's a little bit of both. It's kind of like being a quarterback on the field. You may have a play in mind, the ball snaps and that play no longer looks successful, and you're going to have to switch the play on the field. That's how a tech investor has to be. And I'm going to go through why that is, but I will tell you before we get there towards the end that the majority of the companies you see today on the public markets, if we have an extended economic drawdown, I would say an extended is 1 to 2 years, many of them will not be in business anymore. So you have to be prepared to be flexible and to let go of the stocks that you might have, that you might have had a strong play in mind. You might have thought you're going to hold it forever, 5 years, 10 years, something like that. Maybe you're going to pass the stock on to your grandkids. All of that has to be pushed aside because right now they have to earn a place in your portfolio. You can't be so romanticized with a story that it has a place in your portfolio without merit. So every stock of mine, even those that I think will have amazing products and amazing positioning in 10 years, they have to earn that spot today. And that's me being flexible and willing to change the play on the field if the information I'm given is showing me that play is no longer going to work. So those are the qualities of a tech investor. It's way easier to invest in value stocks and to go for dividends, way easier. And those people look brilliant this year. And they may be brilliant, but over a period of time, a tech investor more times than not will outperform. But you have to have all of those qualities, which is knowing your skiing level, not being a beginner on advanced slopes or an intermediate on an advanced slope. And you also have to know what is really, really, really a tech investor. And those are some qualities that I would identify as a tech investor. I won't spend too long on this slide. We've all lived 2022, but I think it's important to just really quick get on the same page as to what really happened. Ultimately, inflation went up and rates went up to control inflation. What was unique about the last year is that bonds, the bull market in bonds ended at the same time as the bull market in stocks. That's actually not very common. So a lot of global money and institutions had nowhere to go. So the dollar went up. A lot of them tried to go into the dollar. And that's actually also unusual where the dollar goes up with inflation. So ultimately, what does that mean for tech? Well, tech is a long duration asset. So you're actually buying stake in the future cash flows and the future earnings. So the reason why this industry is so sensitive is because it's all priced on the future cash flows. And if cash gets re-rated and becomes more expensive, tech stocks go down. Again, this particular industry also does not always have cash flows or earnings, as you're probably very well aware of now, if you weren't already. And so it is one of the first to crumble, if you will, when inflation is high and cash is being re-rated. So I want to just quickly touch base on that because we want to come up with some parameters as we move into 2023 as to what we're looking for. I hope you can see all of this, all of these stocks. They're not very interesting stocks. They're very, very boring stocks. These are the stocks that performed the best in 2022. A lot of them were energy or semiconductors, but we want to look at a couple of these and determine why were they performing better than some of the more popular pop culture, I guess you could call it, type stocks that performed well previously. Most of these names are not household names. You would never say, to someone at your family or maybe at a bar, like, hey, I own, Supermicro or I own First Solar. And that's kind of the point, I think, as well, is that sometimes the most popular stocks can also have the most wild swings. So I decided to pull out Enphase. It's probably the one that some of you know of. It's one of the best performing stocks of the year. It's up almost 90% year to date. Visually, I think you can probably see pretty quickly that these margins are expanding. At a bare minimum, stocks have to have expanding margins. If you see margins contracting, the market's going to run. Again, it all goes back to the fact that cash is being re-rated and tech as a long duration asset is valued based on future cash flows and earnings. So they're not being traded based on what's happening today. And so if you're contracting, the idea is you need to be re-rated down because you're probably going to be contracting into the future. Profitable on an adjusted basis is probably 90%, if not higher, of my portfolio right now. GAAP profitable is even better. Enphase actually meets all of this criteria, and therefore we're seeing this become maybe the best stock of 2023 across all industries. This is a beautiful margin profile in terms of improving over the last few quarters. The other thing while I'm on it is that most of the time the market is not actually looking at year over year, it's looking at sequentially because it's assumed that last year was entirely different macro conditions. So we're seeing that a lot with cloud right now. People are looking at it and saying, that was a good report because year over year it looked good, but sequentially it may be declining. And so that's more important to the market because it's assumed that 2021 still had ideal conditions. So we're really looking sequentially. And again, you can see here with Enphase, sequentially, it's doing quite well in terms of expansion. This is, I just thought I'd throw in Taiwan Semiconductor, TSM. It's not actually in the top 10 best performing stocks, but I think it's kind of neat that Warren Buffett is getting into this stock. He's been buying it. He's a very conservative investor, in my opinion. He does not own much tech, and he's starting to enter this one. And so I thought, well, why don't we look at what Warren Buffett sees? Is there something that we can pull from here for our parameters as we move into 2023? As we know, cash is being re-rated. So those that have cash are worth a lot more than those who don't have cash. And it's not a matter of just not having cash. Again, it's a matter of, are you expanding or are you contracting your cash margin? And how long do you have to go? How much cash do you have before you'd have to raise again? Here we're seeing again, sequentially, at least from January through July, that TSM was expanding quite well within the free cash flow per share. It has flatlined, but most people in the institutional level, they have pulled back a little bit from semis, but it's understood that semis have a few risks, if you will, that could be cleared up pretty quickly. They're not as affected by the uncontrollable widespread issues of macro, and it's more around something like China, supply chain, things like that. So there's actually a solution that you can track. Therefore, semis can be somewhat attractive right now because lots of companies are still buying semiconductors despite a potential economic pullback. You know, I'm picking on cloud because we just had a lot of best of breeds report. We can't say the same for cloud. We're seeing a strong deceleration from Q3 to Q4. Personally, I don't think we've ever seen anything like that in cloud, pretty sure. We're seeing almost a 30 to 50% deceleration from Q3 to Q4. If they didn't get hit in Q4 with their guide, then it's their forward fiscal. That's an uncontrollable force, which is budgets, enterprise budgets, which are going to be determined next year. Where semiconductors, again, it's a little more easier to predict or easier to track, if you will, something like China, supply chains, things of that sort. Not super easy, but easier. So Taiwan Semiconductor probably looks good to Warren Buffett because of that cash. And that's the kind of thing that you want to pay attention to. You know, this is a beautiful chart for 2023. So one stock that I own that I think may have bottomed is actually Netflix. Within the parameters that I've shown you, it may not look like much of a recovery yet, but this company has is slated for about $1 billion in free cash flow this year and is substantially going to improve it for next year. I'm guessing substantially means somewhere around 2 billion. So this is going to tick up quite nicely. And I do think that, Netflix is within a bottoming pattern with its bottom line. It's also helpful that the company is returning to revenue growth, to user growth. That's way less important than the fact that it's improving its free cash flow margin. And in addition to that, I have seen already the market greatly reward people who are improving their bottom line with very little to no growth. And so that's a huge clue. And therefore, you could look at Netflix's revenue growth and say, that's not super impressive, but you're probably using a 2021 parameter. For 2023, what's impressive is moving into a much better bottom line margin, similar to what we've been looking at. Obviously, TSM and Enphase, way more obvious, but that's again why Enphase has already been rewarded. Technically, Taiwan Semiconductors has already been rewarded too at negative 30%, where some of the other semis are more like negative 50 right now. So there's been some reward for Taiwan Semiconductors in that regard. Netflix has not been fully rewarded yet. It may be rewarded when and if we see that line tick back up. And again, I think that will happen next year when they double their free cash flow from this year. NVIDIA is another company that I think has bottomed. And this one I wanted to pull out because the media will not let you know that. They will not go through the financials and say, from here on out, GAAP EPS and the GAAP operating margin are going to be improving. And the biggest concern, which is gaming, management said has bottomed. So we have a little bit of a break on the revenue decline, a little bit of a hint from management that it shouldn't be getting any worse from here. That's always helpful. But ultimately, you can quickly see here that the EPS estimates should be hitting, much higher as we move into the next fiscal year. Looks like 100%, 200% improvement, meaning NVIDIA will return to where it always was. This is not a new trajectory for NVIDIA, but it's a bottoming pattern. And if you weren't lucky enough to get into Enphase at the beginning of the year, I was not lucky enough. This is the kind of thing to look for, which is just things that are improving on the bottom line. Again, I'm not a financial advisor. These stocks could do anything next year. They could have a earnings report that does not show these bottom lines improving or expanding. Every earnings report is a new opportunity for management to give us information. But with the information we have today, they're both slated to improve and have technically bottomed per their fundamentals on the bottom line. So before I conclude, I just want to talk a little bit about a couple of bigger mistakes too that the tech industry faces. Again, I don't know that, I guess maybe I should have worded this headline a little differently. I don't think this is a mistake that tech investors are making. I think it's the biggest risk to the tech industry as a whole, which is that most tech companies will not survive. I'm not trying to put like any, fear out there or anything like too, doom and gloom. But the truth is that it took thousands of companies before we got a FANG. And I've seen that cycle. I've seen there be thousands of mobile apps with only a handful or a dozen that make any real profits today or are investable today. I've seen it with ad tech. There were hundreds, if not thousands. I think there were 3,000 companies on the market when Google and Facebook consolidated the market and wiped them all out. I'm talking 3,000 companies that were wiped out within a year or two. Gaming was overtaking Hollywood around 2014 as the most valuable entertainment industry. It still is today, but some of those big time apps that were crushing the app store are not actually investable, and some of them went out of business entirely. Zynga, I guess, would be the best. Zynga is like the poster child for what I'm talking about. There were many, many, many Zyngas in the market. And so when it comes to the .com boom and bust, the cycle should be much, much shorter, meaning the recovery for tech, because we have massive markets on the way. AI and machine learning is not to be underestimated. But when it comes to the bust boom of the .com, and then I would say the bust boom of the mobile era, which you all lived through, even though you may not have noticed it, you probably were downloading, I don't know, hundreds of apps at one point, over 100 apps in your life. Where are they? You probably use 5, I don't know, maybe 10. But the one thing that probably has in common here is the rate of success. And I actually think the next cycle is cloud. And I think I actually have that here. Yeah. Consolidation, I believe, is coming in cloud. The reason why I think this is the next one to go through a boom bust cycle, meaning bust because we've clearly had our boom, is because the sheer number of software, cloud platforms on the market is astonishing. You have to consider the private markets. I think the companies, the bigger, stock market banner type companies, maybe your Snowflake, maybe your CrowdStrike, they take up a lot of attention, but underneath that percolating is a ton of competition in the private markets, a lot of competition on the software side. One great example of a wonderful product that was acquired is Slack. I mean, who doesn't use Slack? What an awesome product. That was one of the best products really in terms of the amount that I use an app, but it was not strong enough to compete, and it was acquired by a stronger company, and that stock really wasn't the best stock to own because of a consolidation pattern. I think that if we have an extended recession, don't know how long a recession would go. Some people argue it's shallow, some people argue it's deep. That's not within my expertise. All I know is the deeper it is, the more consolidation and the fewer cloud companies that will make it. The other reason I think cloud is set to be the next for strong consolidation and a boom bust cycle is because cloud has very weak bottom lines. If we're being really honest with ourselves, those bottom lines are awful. There's very few cloud companies. I run this data all of the time. I want to say I can barely get a top 10 list on adjusted profitability before we slip into negative adjusted EPS and things on the top 10 list. I want to say at any given time, there's 6 or 7. And that doesn't even touch cash flow. There's, between adjusted profitability and free cash flow positive, I want to say there's about 3 or 4. Why is that? There's hundreds of cloud companies on the market between the private and the public. And why is this also going to be tested? Because one thing I've been making a note to my premium people on is that deceleration we just saw from Q3, Q4 should have everybody concerned. This is a massive deceleration. We're seeing 67% revenue growth one quarter, Q3, drop to 40% the next quarter. That's not great. I don't know how else to say it other than if we get one more decel of that level and going into Q1, where are we going to land? 20%, 15% revenue growth from companies that used to have 40 to 60 to 70%. So, I mean, I laugh about it because it can get intense, but we also want to get in front of it. And if budgets, basically the way most budgets work is that an enterprise budget is that they're determined around the first of the year. And let's say some company says, I want to spend $1 million on cloud or 10 million on cloud. It's a, enterprise. Come the end of the year, they've got to flush out that budget. They've got to finish the budget off. So if it's a 10 million budget and they still have 4 million left, they'll just really quick get rid of the 4 million and spend it wherever they can. They're not doing that this year. They're holding back from what is considered a holiday flush. That's why you're seeing those growth rates plummet, really. So the question that we need to ask ourselves, if you happen to be in tech, and again, I kind of picking on cloud, not only because they just reported, but because this category has treated us very, very well. I mean, this has been an awesome category. We're talking super high growth rates. COVID years was like all about cloud. So that flexibility of the quarterback on the field, changing his play, is going to be tested right now because cloud treated people so incredibly well. There will be some strong companies that survive. I'm not trying to be a doom and gloom here, but I think all stocks need to earn their place in your portfolio. It can't be that, this stock was so great during, a year ago with this level of deceleration. The other thing that I feel like is a big thing for, I like to touch base on this, that we saw happen again, and we'll see. We already saw happen recently. We'll see it again. We've seen it in the past. Almost every boom bust has been tied to this, is the fact that the public markets are really just an exit strategy for venture capitalists. They doll these companies up. I mean, these companies, your Instagram filter where you can take whatever your worst picture and make it look like your best. That's what they do for these startups. They make these startups look fantastic on the IPO exit. They have super high growth rates. They tighten, the margins. They can, they get the margins to look really good, and they tighten the belt on growth. And that's one of the biggest reasons why a great company that goes public frequently looks entirely different a year or two later. Is because this is just an exit strategy machine for venture capitalists, and it falls onto us. It's our job to figure out which of these are actually viable, and just keep in mind that all of them look beautiful and amazing coming out that exit door. But that's because they got dolled up and were pushed out looking perfect. It doesn't mean that they can sustain that level of perfection. And what happens right before the bust is we had one big IPO after another, those big Airbnb IPOs, those big Snowflake, DoorDash IPOs. What was going on there is that the public markets are simply an exit strategy. Will they survive? They don't care. Venture capitalists do not care. They got their money and they're out. The founders don't care. They'll get their money and they're out. We have to care because we're the ones who get left holding the bag. So that's another thing to keep in mind. And if you see a ton of IPOs flooding the market in the future, it's pretty good signal. We must be topping because VCs have impeccable timing. So well-known companies may not survive. Again, I guess the Slack is the best example I have. Tons of gaming apps were used and still might be used, but that doesn't mean that they're investable companies. So it's not about what do you use on a daily basis or what's popular or what is your enterprise company using? There's a much bigger picture going on, which is, can this company get through a recession where cash is expensive, their bottom line isn't the best, and budgets are being cut. And again, I'm going with what I know from 2022, where there'll be a huge break in the clouds. The sun starts shining in May, and this recession is entirely over. That's outside of my scope. What I go with is what I know today. So I'm presenting what I know today. If I were to guess, we've tried to guess, we're thinking 2024 is when we could start taking bigger chances on the bottom line. Cool. So risk management, I think this is my last slide. Yep, it's pretty much my last slide. If you're a beginner, just hold for a long period of time. That's pretty much your only risk management because you don't have the time. Medium risk stocks, you can use stops. That's a great risk management. Advanced hedges the market. I have a full-time portfolio manager. He hedges the market. Because I'm analyzing stocks all day, I could not be considered in advance because I have a full-time position where I'm not actually trading stocks. I'm analyzing stocks. So anyways, advanced is hedging the market. Again, I just want to emphasize, we do a lot of free content. I do a free weekly newsletter. The portfolio manager does a free YouTube channel. More than 50% of that is about his hedging strategy. It's always good to know, because even if you're not going to hedge, his point is the broad market going up or down. My Twitter handle has a ton of charts and data on it, and our premium service starts at $99 a year. So thanks, everybody.
Perfect, Beth. That was extremely useful. And there's a ton of people in the audience and there's a ton of questions. So we've got a big job to get through all of them. I've got about 3 pages of questions for you, but I'll save them for our podcast later on. The first question is from Ravi. What platforms would you recommend to use and filter and research stocks? And what are the key metrics ratios to focus on as a starting point? Obviously, you've mentioned free cash flow margins and earnings per share and adjusted earnings. But for a modern investor that has 5 minutes, 10 minutes on the train or in the taxi, what would you recommend in terms of your process? Like, what's the best time, spent basically?
Yeah, I guess it would go back to those levels. If you only have the 5 minutes, I would stick with the mega cap tech stocks, and there's no shame in that. I mean, these are great stocks. They're the most likely to survive and do very well in the future. And from there, what I would look at is recovery. Are you, I guess the number one question that I haven't answered directly, although I showed you with Netflix and Nvidia, is this stock expected to bottom? So Google, I would need to go back and look, just using them, picking on them because they've had, some bad earnings. When are analysts expecting those earnings to turn back up? And the safest thing to do would be to wait for that acceleration. So let's say it's 4% growth, or I can't remember what their growth is, but say it's 4% growth one quarter and it's expected to go up to 8% growth from there, 12 or something. You would wait for that 8% to come in and then buy that night, buy after hours if you can, or buy in the morning. I really am a big fan in this market to wait for that information to come in, go ahead and buy or sell. In fact, we've reduced a lot of risk going into earnings. Some of them have been smart, some of them have not, or, some of them have popped. I don't care because I'm reducing risk. So it's more important to reduce risk than to go to the river, like in poker, with a company and a management team that hasn't shown us they're ready to accelerate their revenue. So, and bottom line. So look for those bottoms, visually even you can look for those. But I would start with your fangs and look for the bottom and wait for it to happen.
Great answer. Second question is from Alessandro. Which emerging technologies or tools will make the biggest financial and social impact? Obviously, overlaying what we've seen in the last 5 days or so with ChatGPT getting to 1 million users. What kind of tools are you looking at that's going to have that big impact?
Yeah, we actually use an automated hedge signal that was designed by a quant type. And even still, they call it the man in the machine. I would like to call it the woman in the machine. The human will usually beat the machine, and that's the advantage I think that will always be there, because there's just so many data points. There's so many, automation usually one thing that it uses is after hours, it's determining, sentiment, but ultimately it could be wrong. And I think looking for where it's wrong is a great way to go. But as far as tools go now, we use Y charts a lot just because it's easy and it's fast. But we do a lot of old fashioned, looking through SEC or, SEC filings and things like that, because nothing quite beats that manual work. Nobody's willing to do it. So if you're willing to do it, you can outperform because you'll find things nobody else knows.
Okay. And the next question from TJ. When analyzing your personal portfolio, what are the 1 to 2 red flags that automatically should cause them to rethink their sector exposure?
Could you repeat that?
So basically,
my personal portfolio?
Yeah. So when you're looking at your personal portfolio, what are the 1 to 2 red flags that basically make you think, wow, okay, I'm overexposed in this area?
I mean, the number one thing I think where anyone needs to be careful being overexposed is contracting margins. And I truly mean that. Almost every single sell-off or steeper than peers, sell-off that was steeper than their peers was related to an earnings report where the margin was weaker than the previous margin. And I mean, it's really that simple. It causes the stock to completely plummet after hours. I mean, we actually saw that with, you actually see it the opposite direction too.
Contracting margins, that's the key thing for everyone to take away. In terms of mega cap tech stocks that, for the majority of the people in the room, you've kind of alluded to, they should focus on those, given the time constraints that everyone has. What are your thoughts on your Amazons, Googles, Metas, particularly Meta, because I've read one of your interesting articles about their CapEx and expenses, and obviously they've been in the news. What's your outlook for big cap tech for 2023? Because I saw Amazon's trading, I think, triple. It's 3 times as expensive as Google on an NTM earnings basis, I think I saw earlier today. So what's your outlook on big tech?
That's a great question. Big tech is rarely on sale. And the other thing to think of is who's most likely to do well with AI and machine learning long-term. Of course, it's going to be big tech. So this does actually remind me of the great financial crisis or something where you're getting companies at a steep discount that are going to later dominate mobile. And in this case, you're getting companies at a steep discount that will later dominate AI and machine learning. Obviously, cloud infrastructure is entirely really designed, the footprints they've laid are designed to capture the AI ML market. So ultimately, we are built, we plan, if we haven't built the position, we plan to build a position. And the ones to look for are the ones that you think are going to crush AI and ML. And I actually like the enterprise side. I like Microsoft. I think that who's the biggest customer for AI, ML, probably enterprise. That's my best guess right now. Okay. Consumer will obviously consume it, but will, those customers, I think the real customers will probably come from enterprise.
That's really interesting. And I guess a follow-up question from me is, which AI or ML companies that we've not mentioned could break into that kind of FANG space? Like, who are going to be the big winners in that space, do you think?
For times of economic expansion, I like the consumption model. I do think that even if we see a stronger deceleration from Snowflake, MongoDB, Confluent, those are the 3 that come to mind. Come economic expansion, they'd be good ones to come back to. It's entirely fine to leave a stock and come back to it. We do it all the time. That's probably our most successful play on the field, is go ahead and leave a stock and come back, because it may not be worth parking your money for a year to just get the 20% off the bottom. It might be okay to leave that 20% on the table and come back for better timing, because you could have maybe put it into Enphase. Again, I didn't own Enphase, but if you could have put that into Enphase and then gone ahead and return to something like Snowflake, I would say, but I want to categorize it more as the consumption model is what I think would do best as something to watch as a tip.
Perfect. And there's one question from Marco discussing kind of looking into 2023. Geopolitics obviously has been a dominant theme this year. What other macro themes? Obviously, I can tell, and from your research and analysis, that you're really at heart a fundamental investor, and you're looking at all these free cash flow margins and earnings. But obviously, inflation, geopolitics, supply chains has been dominant this year. So, what themes are you looking out into 2023 and going, "Oh, that could be something that's going to drive the macro, that's going to then obviously impact the tech sector"?
Supply chains is still a great answer. When those ease, supply and demand should be a little bit more even, because obviously prices are high, because supply is constricted. So if we can get the right amount of supply, prices will look better, average sales prices. So anyways, the other thing I guess would be, China is always a good one to look at. China has its, is part of everything we do, whether we want to admit it or not. So whatever China's doing usually has an effect on the rest of the world. Basically, you could say that's connected to supply, but I think there's more to it. Again, politically, not my world, but we're seeing some of the foundries come over to the United States. But China's always been kind of a thorn in the tech industry side, because whatever they do can really affect our stocks. So those are some things I would look for.
And there's a question from Oliver. Obviously, we talk. You take short-term positions, but you also have longer-term picks as well. What tech stocks would you say are probably the best, most likely to win in the next 5 to 10 year kind of time frame, which is probably what most modern investors are looking for in terms of their holding period?
Yeah, I've always been kind of vocal about NVIDIA. I think that NVIDIA has a near monopoly on, AI accelerators, especially GPUs. And so when you take that level of market positioning, you add the enormous market of AI and machine learning, which will be larger than mobile, what you get is a pretty safer bet. Nothing's entirely safe, but you get a pretty strong bet on the next 5 years. There's other things too about NVIDIA that I write about. You can check it out on my blog. It's for free. But I go into way more specifics on that company.
Yeah. There's a question here from Isabel. Your thoughts on Apple?
Okay, that's a great question. I consider Apple a value stock. Just has been low growth for a long time. This is not really an economy thing where, some of these other companies were 20% or higher, these other FANGs, and now they're really soft. It's just been low growth, amazing cash, top cash, I think, of any stock really in the market. I would have to check that fact, but it's up there. And so it's a great value stock. So it meets those parameters that we discussed. But is it going to be the leading FANG based on, emerging technology markets, things like that? Maybe not. I don't see where they're going to dominate next. I know that they have a lot of irons in the fire, and that's good. But I can kind of say, like, I know where AI ML is going to go for Google. They're just going to power the ads that they have, and they're going to make way more money. They're probably going to cut off third-party data. I can see that, on Chrome and Android. I can see where Microsoft is going to sell into the Fortune 500, which they control 90% of, across all their products, cybersecurity, things like that. But when it comes to Apple, I hesitate to find where's their next big growth market, but I don't know that it matters because they have so much cash.
Yeah. And given your background in tech, just more generally, there's quite an interesting question from Sarah that I think is quite useful for everyone. What makes a good product or service? You talked about Slack and like a product that is, fantastic, that obviously was acquired by Salesforce. What makes a good product?
Wow, that's an excellent question. They call it product market fit. Sometimes on earnings calls, you'll hear a term called flywheel. What it means is that the product starts to sell itself. So if I go into a company and I'm a newer employee and I'm like, you have to get Slack because it just functions so much better. When people start to sell your product for you, when your best friend or whoever said you have to get on Facebook because I'm on Facebook, that's a signal of product market fit. When it starts to just naturally sell itself, and you don't have to have a huge sales and marketing budget. I guess if you were to say, how do you quantify this? A huge sales and marketing budget would signal more of a growth hacking strategy where you're going to pay X amount per customer. Nothing wrong with that, as long as the lifetime value and the customer acquisition cost equal out. So I made a point on Uber. I'll give you an example of a company I didn't think actually had product market fit that you might think did. So it's just more of a debate. Nobody's right or wrong. I'm just bringing up an argument or a side to a story that Uber had to pay more per customer than what they were making from that customer. To me, that's not product market fit because the sales and marketing budget is so high. Product market fit would be, I don't need to acquire customers through paid ads only. It's starting to sell itself.
Yeah, perfect. And Look, we could speak for hours, to be honest, but unfortunately we're out of time. So thank you so much, Beth. It's been incredibly insightful, and you've got a lot of fans in the chat, clearly. So just before we end this session, Beth, where can everyone find you after this?
Try iofund.com. Again, I have a free newsletter. It goes out almost religiously every week, and I do a lot of free in-depth analysis. I try to really give you actionable things that I'm using for my own portfolio. And then Twitter, LinkedIn, those are the main areas. And you can check out YouTube if you want more of a technical analysis or hedging approach from my team member.
Perfect.
Yeah.
Perfect. Thank you, Beth, and thank you everyone for joining. It's been an amazing session. Take care.
Thank you so much. Take care.